China has failed to halt its share market slide, heightening fears of ongoing turmoil in the world's second biggest economy. Predictions of a 10% fall prompted Beijing to take emergency action, limiting trading and pumping billions of dollars into stocks. China correspondent Stephen McDonnell is in Beijing.
It's been another volatile day on the Chinese stock market. Nervous investors have been selling and the government buying, promising $11 billion to stop a full-blown wipeout. As a result, the Shanghai Composite Index seesawed, hitting a low of below 5%, ending the day 1.5% down, after Monday's biggest one-day drop in 8 years. Some see this as a natural correction.
Probably the healthiest thing for the stock market now would be to come off a little bit further, for maybe the market to trade sideways or down over the next 6 months.
If this is a response to overpriced shares, it could mean the current sell-off has nothing to do with confidence in the Chinese economy. But there are other worrying signs, like the slowing real estate and manufacturing sectors, and any impact on consumer sentiment could eventually have global consequences.
China cannot get weak because otherwise the entire world economy will have a problem and Greece will look like a children's birthday party in comparison.
The stock market here is still something of a sideshow, which could even collapse without massive impact on the overall economy. But when it turns bad, it's the small investors who suffer.
If it goes up or down too sharply, people will not be able to cope with it. For the time being, I've lost all my profit, but broken even.
This is a Chinese brokerage with ordinary people buying and selling shares. If it looks like the type of place you might bet on the horses, then perhaps that's an apt comparison, with many here making their trading decisions based purely on what others are doing. And outside the brokerage, it seems a lack of faith in share trading has turned some to more traditional forms of gambling. Stephen McDonnell, ABC News, Beijing.
China's middle class is the fastest growing consumer market in the world, but the unstable share market is worrying the big multinationals who've been banking on China's cashed up spenders. Finance correspondent Philip Lasker explains.
For a culture spanning thousands of years, China's stock market is a newborn.
China is still in its Wild West phase of development to a certain extent, mirroring what we did see in the US.
The 20-year-old Shanghai Exchange is like Wall Street during the 1920s before it crashed, when wealthy families like the Rockefellers dominated the scene. It's a very different animal to markets in the developed Western economies. More than 60% of the market is locked up by wealthy individuals and state-owned enterprises. In Australia, it's 15%, if that. China has a higher proportion of retail investors, but Australians have a lot tied up in superannuation funds, a virtually non-existent sector in Shanghai. Instead, there's the government and insurance companies. Foreign investors are not in Shanghai, but they have a big presence in Australia. Share investors, while a relatively small proportion of the population, are the big spenders, and they like expensive overseas goods. For instance, luxury brand Louis Vuitton is feeling the pressure as sales growth slows. First half car sales in China grew at the slowest pace in 6 years, and for some luxury car brands, Chinese drivers represent up to 50% of their net earnings.
Every country in the world, you've got signs of some excesses in asset markets, and I think that's something we need to be concerned about.
But China's dealing with a triple whammy.
If you've got property prices coming under downward pressure, equity prices coming under downward pressure, and the economy slowing at the same time, that's a pretty worrying combination.
A combination that could have widespread consequences. Philip Lasker, ABC News.